Assalamu alaikum. Welcome to lecture 21, Inheritance Tax. So for inheritance tax, this is the only lecture that we are going to cover. Inheritance tax means, as the word says, inheritance. You are taxing on the inheritance when you are receiving anything as a gift, okay? Either from your parents or your spouse or anyone, a gift. It could be, let's say, a property that is gifted to you, or shares, a house, anything that is gifted. Like you have inherited it, there will be tax that you have to pay on the value of the property. So now, here, what is the concept of inheritance? The scope of charge. What does IST cover? Then, what is transfer of value? Property for IST purposes. What are the properties that are taken for IHT, that is inheritance? Then, what is chargeable transfer? Now, when does inheritance tax becomes chargeable? Lifetime transfer. Then we have some exemptions under this. Exemptions that apply to lifetime transfers and death estate. Spouse exemption is there. Then we have exemptions that apply only to lifetime transfer. Then how to compute IST during lifetime. This is known as stage 1 computation. Also known as CLT, chargeable lifetime transfer. It is forever chargeable, it is never exempt. Then we have nil rate ban. Then we have 7-year accumulation principle. Then we are going to compute IST payable on death. Remember, IST can be calculated twice. Once during lifetime and the other one is on death. So IST arising as a result of death, this is known as stage 2 computation. Death tax on lifetime transfer. Then IST on death state. This is stage 3 computation. There are 3 stages: stage 1, stage 2, stage 3. We will be going through all the 3 stages in this lecture. Then the nil rate ban and the tax rates. Residence nil rate ban. This residence nil rate ban is only when you are inheriting a residence. And for married couples, the transfer of nil rate ban. They can transfer their nil rate ban among themselves. Nil rate ban means up to an amount, it is not chargeable to IST. Now, how the administration of inheritance tax. So what are the due dates of payment of tax? It is whose responsibility to pay the inheritance tax? Then, how do you do the IST planning for lifetime and for death state? And skipping generations, why it is beneficial to skip generation. And then finally we are going to conclude with the syllabus summary and technical articles. So here, occasion of charge, exemptions and the administration. Then we have charging IST during lifetime and death. And then under both we have nil rate ban, residence nil rate ban and married couples. And then the IST planning for lifetime and death state. Now, so when there is a transfer of wealth, or you can say a gift, IST is charged. Inheritance tax is charged on that. No income tax is charged because it's not your income. No, it's not an income for the one who's receiving the gift. No capital gain tax is charged because you're not selling it. This is like you're gifting it. When you're selling a capital asset, yes, it is chargeable to capital gain tax. And then no, it's corporation tax because corporation tax are paid by company. Here an individual is transferring or gifting an asset to someone else. So the main theme here is it should be a gift, as a gift of a property to your daughter. So inheritance tax is charged here. Okay, remember your capital gain tax and inheritance tax. These two taxes are your capital tax. Okay, and your income tax, corporation tax, they are your revenue tax. So whenever the question asks calculate all the capital taxes, it is not just capital gain tax, it includes inheritance tax also. So it's a capital tax levied on the person's wealth. Okay, now IST also has implications on lifetime gift as well as on death. Remember, twice it will have impact. So to prevent people simply giving assets before their death in order to avoid tax. That's why they are taxed twice. Otherwise, what happens is someone might give their property to someone else before their death so they can avoid tax. Okay, in order to prevent that from happening, now IST, there is a implications on lifetime gift as well as on death. So these implications include a charge to IST. Some lifetime gift, there will be a charge to inheritance tax. This is at the time of gift. And you have to consider when you're giving lifetime gifts the 7-year accumulation period. This will cover a little bit later. What is the 7-year accumulation period? This 7-year accumulation period is used for your nil rate band. Then, so lifetime transfers are divided into 3 categories. First, chargeable lifetime transfer. Then potential exempt transfer. This PET is a transfer where currently it is exempt, potentially. Okay, it might be exempt later in the future. Currently it is exempt, but in the future it will be exempt or not depends on when the donor is dying. Is he dying within 7 years or not? If he dies within 7 years, it will be chargeable. If he dies after 7 years, more than 7 years, PET becomes exempt forever. You see, it might become exempt, it might not become, it might become chargeable. It has the potential of both. Hence, potentially exempt transfer PET. All these things you will only understand with the calculation. How chargeable lifetime transfer is different from PET and exempt transfers. The transfers which are totally exempt. You have to know these 3 categories now. So first we'll go through CLT. What is CLT? This is one in which is liable to IST when the gift is made at the lifetime rate. So you have to pay IST for the gift at the lifetime rate. And this rate is half the rate that is applying on death. Okay. That means during death, the tax rate is double. And also, to additional IST if the transferor dies within next 7 years. There will be an additional IST if the donor, the one who is giving the property, dies within the next 7 years of gifting. Additional IST, that additional IST that you have to pay, okay, is at the higher death rate. Of course, at the death rate you will be paying the additional IST. So this minus the lifetime tax that you have already paid. Remember, it was a chargeable lifetime transfer. During your life, you have given tax. That IST you have to deduct during death. The tax that you are paying during death. This is for CLT, this situation. Chargeable lifetime transfer only. For PAT, potential exempt transfer, there is no lifetime tax. Okay. And also, the higher death rate will only apply if the transfer dies within 7 years. If the transfer survives the 7 years, no tax at all. It is exempt. Now, what is the scope of the charge? So, IHT applies to the transfer of values. This word you have to be very familiar when you go to IST. That is transfer of value. The IST is charged on transfer of value. Like how income tax is charged on taxable income. Capital gain tax is charged on chargeable gain. And corporation tax is charged on total taxable profit. Same way, inheritance tax is charged on transfer of value. So in any question, you have to find the transfer of value. Transfer of value is simply the value of the gift before you're giving it and the value of the gift after giving it away. The difference is known as transfer of value. That means how much of your value declined after giving away the asset. Okay, it could be any asset, all chargeable property. But if it's an property which is not chargeable to IST and you are gifting it, no IST will be chargeable. Okay. So this charge to IST arises on death of an individual, on lifetime gifts when the transferor dies within 7 years, and on some gifts that are given away in their lifetime either to another individual or into a trust. Now, what is a trust? A trust is an arrangement under which the legal title and the control of the property is transferred from the creator to the trust. Basically, trusts are like the manager. They keep on managing your property, okay, for the benefit of others, that is the beneficiaries. For example, your father has given your property to the trust to look after your property till you reach the age to look after the property yourself. So your father, okay, he's the creator, then there's a trust, and you are the beneficiaries. You understand? This is how it works. So IST is chargeable to individuals and trustees. It does not apply to companies. Okay, ISTs are always chargeable to individuals. Companies do not pay IST and trustees. So the person who give away the asset is the transferor or the donor. Either he's a transfer or donor, you can name anything. The one who gives away the asset is known as transfer or donor, and the recipient, the one who's receiving that gift, is transferee or donee. Now, some exam advice. The syllabus is mainly concerned with the fundamental computational principles of IST. Okay, in your tax, they are more concerned about whether you are able to compute IST or not. Details regarding trust are not required in this level. Okay, it is only necessary to understand what a trust is. You just have to understand what a trust is, and that the transfers into a trust are always a CLT and immediately taxable. Remember this point. Anything that is gifted to a trust is always chargeable. Always IST will be payable, and it's known as chargeable lifetime transfer. So immediately it is taxable. Now, transfer of value. So finally we are moving on to the transfer of value, or what we say diminution in value, because it is the amount by which the transferor's state is reduced by the gift. Okay. Now, so your diminution in value is equals to the market value of the asset transferred, just as it is for gifts of assets for CGT, that is capital gain tax. Now, there's a difference. Okay, the difference arises between the market value of the asset transferred and the diminution in value of the same asset, where the asset's value depends on the proportion of the asset owned before transfer. So a good example of this is the unquoted shares, where a controlling interest may have a higher value per share than a minority interest in the same company. Now, some exam advice. For lifetime transfer, market value is the value on the date of transfer. If it's a lifetime transfer, we'll see what is the date value on the day of transfer. It will be given to you in the exam. Now, for property that is held at death, your market value is the value immediately before death, except for life assurance policy maturing on death where the process figure is taken. If it's a life assurance policy, you have to see the proceeds. Now, example 1. So you have been given the value per share. Okay. Now, A is having 15,000 ordinary share and they have issued 25,000 ordinary share. So here you can see value at 60%, 48%, and 12%. Okay. Now, so here he is having 15%, 15,000. Now, so 15,000 ordinary share that has an issued share capital of 25,000. So now, first you have to see what is the percentage holding to decide the value per share. Then only you can decide the value per share. It is done here. So imagine if he's giving the whole 60% holding to his share as a son, then what happens? Then the value would be at 60% holding. It's 10 per share. Okay. So how many shares? 15,000 shares. Holding 15,000 shares. See, before gifting, he's having 15,000 into 10. That is the 60% interest. This is before transfer, 150. Now, if he's giving the entire 60%, that means after transfer there is no shares held. He'll be having 0. So that means how much value declined from 150 to 50? 150,000. This is the diminution in value. On this you have to pay IST. Okay. Now, when it comes to CGT, remember this 150,000 market value would be the disposal value for CGT because you're disposing this much. Okay, on this you have to pay CGT if you are calculating capital gain tax. Now, moving on to the second scenario where Mr. A gives only 3,000 shares to his son. Okay, so out of 25,000 shares, 3,000 shares is giving. This, if you see, it's a 12% holding. So at 12% holding, value per share is 6. And you're giving 15,000 shares. So you're giving away 12%. So from 60, if 12% goes, after the transfer, you'll be having 48% interest. At 48%, the share price is 8. So you see, you are holding 15,000 shares at 10 before the transfer. After transfer, you will be having 48% because you are giving away 12%. So that means 3,000 shares you are giving. So from 15,000, 3,000 shares went, you are left with 12,000. This will be at 8 at 48% interest. So the difference is this. On this you have to pay IHT, inheritance tax. Okay. When we are going for CGT, what do? So the market value of the 3,000 shares that is transferred. Okay, that is 3,000 into 6. For your CGT, it will be 18,000. Why 3,000 into 6? Because go here. At 12% holding, the value per share is 6. So you're giving away 6 into 15,000. Hence, sorry, 6 into 3,000. You're giving away 3,000 shares. So 3 into 6, 18,000. For CGT, CGT will be charged on 18,000. But IST, the difference between before the gift and after the gift. Okay. Now, so a transfer of value can only arise if the transferor intends to give a gift for a benefit on the transfer. The transfer intended to give away their wealth as in gift. See, your intention has to be you are giving it as a gift, the transferors. Then only it is known as transfer of value. Now, the following transactions will not be treated as transfer of value. Why? Because your main intention is not there. First, if there's a theft of an asset, it is not transfer of value. Because that time the transferor did not intend it for the benefit of the thief. Second, when it's an arm's length sale to an unconnected person, it is not a transfer of value because transfer is receiving the full value for the asset. Third, when you are selling it at an undervalue, so a gift or a sale at undervalue of an asset when the transaction is a genuine commercial transaction. When it's for genuine commercial transaction, it comes under capital gain tax. Okay, when you're gifting or selling an undervalue of an asset, it is not a transfer of value. So this three, because that it is not for the benefit of the transferee, the donee. So in these three situations, it's not transfer of value. Now, what are the property for IST purpose? See, property for IST is all property unless it is excluded property. So unlike CGT, there is no concept of chargeable asset for IST. That means all assets are chargeable to IST. There is nothing like exempt assets for IST. How we have for income tax or capital gain tax or corporation tax, we have some exempt. But here for IST assets, all assets are chargeable to IST. Even if assets are exempt from CGT, but you have to pay IST on that. Okay, unless the property itself is an excluded property, but assets are all chargeable. Now, so exempt assets for CGT like taxpayers' private residence, qualifying corporate bonds, cars, cash, they were exempt from CGT, but on that you have to pay IST. Now, excluded property will not be asked in your exam. That means everything is chargeable. Now, chargeable transfer. So the chargeable amount of a transfer of value may be reduced or eliminated by some exemptions, like how we have income tax exemptions, capital gain tax exemptions, exemptions for corporation tax. Same way for inheritance tax also we have some exemptions and some reliefs that you need to go through. So this exemptions and reliefs if we have will reduce your transfer of value. It will be deducted from your transfer of value. Now, so transfer of value, exemptions, chargeable transfer. Okay, remember this. Now, on this, multiply by IST percentage. So now coming to the occasion of charge. When does IST becomes chargeable? What are the occasions? So IST liability can arise as follows. 1. Lifetime IST. This is known as stage 1 computation. When individual is making a chargeable lifetime transfer. This often happens when you are gifting it to a trust. Okay, in your exam they will ask you this much only. Anything given to a trust is always CLT, chargeable lifetime transfer. You have to pay IST during your life. Next, additional IST will arise on lifetime transfer if the donor is dying within 7 years. This is stage 2 computation. Here you might have CLT as well as PET. For example, you might give something to a trust and when they are dying within 7 years, additional IST, or PET. You are giving PET means an individual is giving to another individual. That is known as PET, potential exempt transfer. A dad is giving to his son, a dad is giving to his daughter. Okay, like that. They are treated as PET. PET will be chargeable when the donor dies within 7 years. Otherwise, PET will not be chargeable. Next is IST on death state. That is stage 3. Here, when an individual dies, the remaining property, whatever is there at the date of death, will be chargeable to IST twice the rate that is applicable for lifetime IST. So we will be doing all the 3 stages of computation in this lecture. And you have to make sure if you're planning to take ATX in your professional level, if you're planning to take advanced taxation, ATX, you have to be a pro in this. Why? Because there also same things will come with more detail, with more addition. But the foundation, the basic concept remains the same in ATX also here. So as already mentioned, 3 types of lifetime transfer. Exempt transfers, no IST. PET becomes chargeable if donor dies within 7 years of the gift. Chargeable lifetime transfer, taxed immediately, and when the donor dies, additional IST. That also donor dies within 7 years. See, this 7 years rule you have to always remember. We have to die within 7 years of the gift. If he dies after 7 years of the gift, no IST, no additional IST when the donor dies. And PET is also not chargeable. So a CLT is a lifetime transfer except a PET or an exempt transfer. Any lifetime transfer into a trust is a CLT, as I told you before. Anything to a trust. A PET is a lifetime transfer by one individual to another individual, not through a trust. And PET never suffer lifetime tax. See, PET during life you never pay tax. Okay. For PET you only pay tax when a death occurs within 7 years. And CLT. CLT suffers lifetime tax when made and also additional tax when dies. So whatever you have paid in stage 1 will be deducted with the death tax rate on the CLT. Now some exam advice. So, although most transfers made by individuals will be exempt or PET, CLT may feature in an exam question because they are subject to IST at the time of the gift. Remember, any lifetime transfer into a trust has CLT and is taxed immediately. See, the main thing is you will be given a CLT, you will be given a PET and also death state. all three stage computation you will be given in the question if IST is asked, and definitely IST will come. So you have to know. Now the third area in this section, this lecture, is exemptions. Exemptions applying to lifetime transfer and death state. See, there are some exemptions that applies only to lifetime. There are some exemptions that apply only to death state. There are some exemptions that apply to both lifetime transfer and death state. So one such exemption is spouse exemption. Yes, spouse exemption. See, if you're a spouse, from the point of income tax, capital gain tax, IST, you get many benefit. Under income tax, what happens? Basic rate ban could be utilized. Personal allowance could be uh, transferred among the spouses. For capital gain tax, no gain, no loss. And here in IST, what is the advantage? Let's see. So anything, okay, that is transferred among the husband and wife will be covered through spouse exemption, will not be taxable to IST because you are eligible for spouse exemption. But when you're making the computation, separate computations have to be made for each spouse. Okay, and with each spouse separately entitled to IST exemption. See, both spouses might be having their own IST exemptions that you have to show. And also the use of NRB, nil rate ban. This will cover in section 4.3, the nil rate ban. Next, see whether on death state or lifetime transfer, both. If it's a spouse transfer, the total amount is exempted, known as spouse exemption. They're entirely exempt from IST. So the most important implications of these exemptions are the first spouse to die, whoever is the first, either the husband or the wife, the first one to die can leave the whole of their estate to the surviving spouse, which is free of IST. And one spouse can transfer property in their lifetime to other spouse without the incurring IST or CGT. So these are the two main implications. Then these exemptions apply to the full value of all transfers made by the transferor to a spouse in the transferor's lifetime or on death. That means total amount exempted if the exemption the transfer is among the spouses, either during lifetime or death. Now coming to those exemptions which are applicable only to the lifetime transfer, not death. They are: number one, gift out of your income. So if you are giving a cash, okay, cash of any value, it will be exempt from IHT if it can be shown that the gift was made out of your current income as opposed to capital. You are making that gift from your current income, not from your capital. If you can show that, and the value of the cash could be anything, the following conditions has to be satisfied for this exemption to apply. First, the gift is a part of your pattern of you are regularly giving it. For example, every birthday you are receiving that gift, or on Christmas, and the gift is not affecting the transferor's standard of living. That means after the transfers, after tax, standard of living is not reduced by the gift. Okay, and the loss of income because of that gift does not have an adverse financial impact on the transferor's lifestyle. If this happens, this exemption you can apply. So in practice, this exemption will most likely apply only where the transfer has a very large regular income and the remaining income is sufficient to maintain the lifestyle of the transfer. Next exemption, small gift exemption. This is gift out of your income. This is small gift exemption. Small gift means no more than 250. So this exemption applies separately to each transferee and for each tax year. So inheritance tax also follows tax year. Income tax also follows tax year. Capital gain tax also follows tax year. Three types of taxes follow the tax year except corporation tax. It follows the accounting period, and VAT will follow the VAT period. So the exemption applies separately to each transferee for each tax year, and the exemption does not apply if the transferor makes multiple gifts. We are making multiple gifts to one individual in the same tax year and the amount is more than 250. even if each individual gift is under 250 CA. Your individual gift might be less than 250, but if the total is more than 250 to same individual, if you're making the same tax year, then the amount would be taxable. So this exemption does not apply to pet in excess of 250. It cannot exclude the first 250 of a larger gift. So the exemption does not apply to this exemption does not apply to gift to trust. Okay. Now, in practice, these exemptions will be useful to parents or grandparents who are making small gifts to their children or grandchildren. Now, moving on to the third, when there's a gift because of marriage. So this exemption applies to lifetime gifts to a party to a marriage of any asset up to a value of 5,000 if the gift is by parent, 2,500 if the gift is by some remote ancestor like your grandparent or the other party to the marriage, 1,000 by anyone else, could be relative, friends. So the gift must be in the consideration of the marriage. Remember, if you are separated, if you are divorced, you cannot, this marriage exemption will not apply. Okay, so the marriage exemption can be deducted from a larger gift. Let's say the exemption would apply to the first 2,500 of a gift of 4,000 from a grandparent. Okay, let's say you are having a gift of 4,000 from your grandparent. So out of that 4,000, you can deduct 2,500 because 2,500 gift, if you are taking from your remote ancestor like your grandparent, could be deducted. So this is how marriage exemption works. Next exemption is your annual exemption. This annual exemption is 3,000. This is same as your capital gain tax also. There also annual exempt amount AEA is 3,000. Here it is annual exemption 3,000. Okay, so the first 3,000 in the tax year 5th April is exempt. The exemption is applied against gift in a chronological order. You might be having so many gifts in the same tax year, but often the first gift in that tax year will utilize as 3,000 because it follows in a chronological order. If the gift is a pet, okay, let's say pet. See, about pet, you are not sure. It might be chargeable later on because it's depending on the donor's death, whether he's surviving 7 years or not. So the exemption still applies. Even for a pet, you're supposed to deduct the 3,000. Even if the pet might never become chargeable because the transfer survives the 7 years, still the 3,000 lifetime transfer can be utilized by pet. If a person is making both pet and CLT in the same tax year, they should make the CLT first, chargeable lifetime transfer first, so that it ensures that annual exemption amount could be utilized against CLT first. Okay. Next, any unused annual exemption you can carry forward. Not like your personal allowance in income tax or annual exempt amount in capital gain tax. Here, unused annual exemption can be carried forward but only for one tax year. And if so, it must be applied after the current, so it's applied after the current year's annual exemption. So the annual exemption in any one tax year is always 6,000. You take one from the previous year and one of the current year. That's why in your calculations also you will see it's always 3,000, 3,000, 6,000. Don't write direct 6,000. You have to show 3,000 separately for the two different tax years. Now, if two different exemptions apply to the same transfer, let's say you have a marriage exemption also, you have an annual exemption also. Which one do you deduct first? Annual exemption is always deducted last. Why? Annual exemption you can carry forward 1 year, but marriage allowance exemptions you can carry forward. One more thing. See, while I was explaining your income tax, there we went through marriage allowance, and here in inheritance tax is marriage exemption. Do not confuse the two. Marriage allowance and marriage exemptions are two separate things which falls under two different types of tax. Okay. Now, exam advice. So these exemptions should be learned so that you do not avoid losing easy marks, because these exemptions, if you show them, they are very easy marks to get, and they are not given in your exam under the tax rates and all. You have to remember them. Now, example 2. So here Rusty is making the following lifetime gift. Always follow the tax year. You will be given different dates and you will be given this order only. To sister, to son, to trust, to daughter, to wife, anyone. So first one is to a sister. This is pet. Always identify. This is to a trust. It's CLT. To a son. Pet. To a trust. CLT. To a trust. CLT. To his daughter on her marriage. This is a pet, but because it is due to marriage, marriage exemption ME will apply here. And if you follow the date, this is 1st May, 1st December 2022. So this too is in the tax year 2020 to 23. And this one, if you follow 25 September, 1st February 2024, this will follow 2023-24 tax year. Okay, and this too will follow 2024-25 tax year. So 3 different tax years. So now let us do example 2. So whenever you are given a question on inheritance tax, first set up your tax year. It's very important. So let us do that. Okay. Now, so there are 3 tax years starting with 2022-23. Then you have to write to whom you are gifting. It's very important. So the first one is gift to a sister. Which is 1,500. Now, this will be covered by the annual exempt amount itself only because your annual exemption amount currently is 3,000. Okay. So here, annual exemption of, since we are using the current year and the brought forward, here you don't have to bring forward anything. The current year is enough. So it is 3,000, but it will be restricted to 1,500 because your gift is less than 3,000. So here it is 0. And this is, you have to write whether it is a chargeable lifetime transfer or a pet. Because it's a gift to sister, gift to an individual, it's pet. You have to mention it. Okay, so pet is 0. So here, no lifetime tax payable. No lifetime tax payable. Coming to the next, same tax year, gift to trust. So what I'm going to do is I'm just going to copy paste it here. I will just change the person, gift to trust. So what is the value of the gift to trust? It is 2,000. Even this will be covered by the annual exempt amount. Remember, annual exempt amount, same tax year. You have used 1,500. The balance 1,500 could be used from here. And then we have another 500 remaining here. This 500 also you can use. Now you can use the brought forward annual exempt from the previous year to utilize this 500. Okay. So AE 2021-22 brought forward. We are assuming the 3,000 is available. So it would be minus 500. Now, sum function. So here also nothing, but this is chargeable gift. It's chargeable lifetime transfer, CLT, because it is to the trust. Here also no lifetime tax. Now moving on to the next tax year. So I will just copy paste and I will just change the year 2023-24. Okay, gift to son. Gift to son is also pet. So how much? 240. So looking at the amount 240, it is less than 250. So you are eligible for small gift exemption. Small gift exemption because it's less than 250. So full 240. Now this is pet, it is 0. So no lifetime tax. Coming to the next gift, the fourth gift, gift to trust. Okay. So gift to trust is 4,500. Okay. So you can use your current annual exempt amount because you see here you claimed for small gift exemption, not annual exempt amount in this tax year 23-24. So here I can utilize the current annual exempt amount 3,000. This is the current tax year 23-24. Okay. Here the brought forward, I cannot bring forward anything because in the previous year I have utilized the entire this thing. In 22-23 I have utilized here 1,500, here 1,500. So I cannot bring forward it to this year now. I've utilized it. So no annual exemption remaining. Now nothing is remaining. So here this is your CLT. You have to pay on this 1,500. This is gross CLT. And if you see this 1,500, still you don't know the nil rate band. Okay, we haven't covered that, but the nil rate band is 325,000, which we will cover in the next slide. So here this 1,500 CLT will be covered by the nil rate band. Therefore, this also will not be taxable. Now, moving on to the next tax year, 2024-25. So here you are gifting to trust 1,200. This will be covered by the annual exempt amount. $1,200. Annual exempt 24-25. Out of 3,000, 1,200 I have utilized. So this is CLT. 0, no tax. Now the next one, the last one, gift to daughter. So gift to daughter is 10,000. And now she can claim marriage exemption. Remember marriage exemption. MA. How much? Who is gifting to whom? 10,000 to his daughter on her marriage. Okay. So up to 5,000 she can deduct because they are given to his daughter. 5,000. Then the remaining, see, out of 3,000, 1,200 was utilized. The remaining is annual exempt amount of 24-25. 1,800 the balance. So now this is a pet. This is a pet of 3,200. Here also no IST, unless Rusty dies within 7 years of the gift. Okay, and we don't know whether he'll be alive or not. So now we'll be moving on to activity 1. So we have finished example 2. Activity 1 is similar to that. Okay, here we are assuming John dies in 2026. So here we are assuming John dies in Jan 2026. Calculate the chargeable amount for each of the gifts after all the relevant exemptions. So here we have to brother, sister, wife. Remember, wife exemption. It is exemption. To wife, spouse exemption is there. Okay. So to his wife it is exempted, then his cousin and son of his marriage. So marriage exemption will be allowable. John had fully utilized his annual exemption for 2022-23 and income in all years is not large to justify the give out of income exemption for 23, 24 and 24, 25. So now let us calculate. So how we have done for example 2, we will be doing for activity 1. So in the same place, we'll put so here we are going to put the different tax years. So we have 2023 to 24. The first one. Here we are having so 1st May 2023, 1st June 2023, 12th Jan 2024. The first 3 gifts are in the tax year 23, 24. And the next one are 24, 25. So now, if you see here, all are pet. There is nothing that goes to trust. So now we are going to solve it here. The first one is give to brother. So here it's a pet and the amount was 200. So 200 comes out of small gift exemption, which is less than 250. So now there is nothing that is chargeable. Okay. Now the next is give to sister. Give to sister is 1800, which will be covered by the annual exempt amount. So this is pet. Now, so we will be going to 12 Jan 2024, the gift to wife of 10,000. Remember, the gift to wife of 10,000 will be fully exempt. You have to deduct spouse exemption of 10,000. Okay. Now, we will be going to the next tax year, that is 24, 25. There are 2 gifts that is made. One is gift to cousin. So gift to cousin is 300. So this 300 annual exempt will come under annual exempt. So nothing is chargeable. Now the next is gift to son. So gift to son is 8,500. Then first we are going to deduct the marriage exemption. which is 5,000, and then the balance annual exempt amount. So if you see here, in this year we have another gift 300. So we have utilized out of 3,300 we have utilized the annual exempt amount. So the balance would be deducted. So from 3,000, 300 has been utilized for gift to cousin. So now the balance 2,700 would be deducted as annual exempt amount. And you are left with 800. This 800 also will be covered by the annual exempt amount brought forward from the previous year, 23-24. So this 800 also will be covered by the annual exempt amount of 23-24. Hence, everything is 0. So nothing is chargeable to inheritance tax. So this is the answer for example 2, where in the same tax year we have gift to sister and trust. And here 1,500 is utilized out of annual exempt amount. The balance 1,500. This 500 is carried forward from the previous year. Then we move on to next year, that is gift to son and gift to trust. So this 240 is covered by small gift exemption, and this 4,500 is covered by annual exempt amount. So this 1,500 will also, you don't have to pay any tax because it will be covered by the nil rate band. Nil rate band, by the way, is 325,000. That means up to 325,000 you don't have to pay any tax. Okay, no IST. As there were no chargeable gift in the previous 7 years. Next, 2024-25, we have two gifts again, gift to trust and gift to daughter. Gift to trust again will be covered by annual exempt amount since it's less than 3,000. Gift to daughter, since there is a marriage exemption, there was a gift by the father due to marriage, so 5,000 can be deducted, and then the balance will be deducted from the annual exempt amount. There is no annual exempt amount remaining from 23-24, the previous year, to be brought forward. 3,200. Even this will be covered by the nil rate band. But since it's gift to daughter, it's a pet. If Rusty does not die within 7 years, it will be exempt. Otherwise, it will be taxable. Moving to activity 1. So in activity 1, also we have small gift exemption here, less than 250. This is covered by annual exempt amount. This is gift to spouse of fully 10,000, spouse exemption, nothing to be taxed. Then gift to cousin 300, a small gift. Then we are moving on, marriage exemption, annual exempt amount, the remaining. Okay, this 300 was utilized here. And then the balance from 23-24 brought forward. So nothing is taxable. Now we are moving on to IHT. So when an individual makes a gift into a trust, it is a CLT and immediately chargeable to lifetime IHT. Pet are not liable to lifetime tax at the time of gift. Okay, but still you have to calculate the chargeable amount. And pet will use the annual exemption, even if it never becomes chargeable. The chargeable amount of each lifetime gift, whether it's pet, whether it is CLT, has to be calculated separately in a chronological order. We have just done it. And okay, and you have to prepare a timeline so that you can use it to prepare to check the 7-year accumulation period. This will cover in section 4.4. Okay, when we are taking the 7-year accumulation period, you have to take both your CLT and pet. Now this is the pro forma. So first, value of gift less exemptions, any exempt transfer like spouse, any other exemptions like marriage or small gift, and annual exemption current year and annual exemption brought forward. So this is the pro forma, and you need to calculate the chargeable amount. Now stage 1. So we'll calculate the chargeable amount as per section 4.1. Deduct the nil rate band remaining. This will cover in the next section. And nil rate band at the date of gift. So how do you know how much nil rate band is remaining? This is how you do it. From the nil rate band at the date of gift, you deduct what CLTs in 7 years before the gift. That's why you need the 7-year accumulation period. Did you made any chargeable lifetime transfer before the date of the gift, 7 years before the date of the gift? If you have used, it will utilize your nil rate band. That's why you have to deduct it from your nil rate band. And whatever is remaining, you will deduct from the chargeable amount, and on this amount you will be paying tax at 20%. Tax is at 20% if the transferee is paying, and tax or 20 divided by 80, that is 25% if the transferee is paying. 20% if transferee, 25% if transferee is paying. So, exam advice: learn the pro forma, and they can be combined to answer an exam question as shown in the solution to activity 2. So now we'll be doing activity 2. So the normal practice of the examining team is to state who is paying the tax in the question. Normally they will tell you who is paying in the question, but if nothing is stated in the question, you should always assume transferor pays the tax and state this in your answer. Now, a tax liability arises at the time of transfer calculated using the lifetime rate applicable at that date. 20% is paid. So it is payable by the donor unless the transferor agrees to be liable. Okay? Donor pays it. If the transferor pays the tax, the gift is referred to as net gift if the transferor is paying the tax. And if you see, your transfer of value is gross amount. So what do? You can't deduct net amount with the gross amount. It has to be gross. So you have to gross up, which equals the net amount of the gift plus the tax thereon. So what do? With the net amount of your gift, you add the tax. This is because transferor has lost both the gift and also the tax payable. So that's why you have to gross up the gift to include the tax payable by the transferor. So the tax attributable to the gift is 25% into the 20 divided by 80, which is 25%, into chargeable value, where the chargeable value is the net amount. If the transferee pays the tax, the gift is gross gift. It is 20% on the gross chargeable value. Whether the tax actually becomes payable depends on whether the cumulative total of the transfer exceeds the relevant nil rate band. Remember, all your transfer together, if you're adding, it has to exceed your nil rate band, which is 325,000, as shown in the pro forma above. Now, nil rate band. Every individual is entitled to a nil rate band. So, nil rate band for 24-25 is 325,000. The amount on which individuals should not pay IHT. This has been unchanged since the tax year 2009 to 10. Since then, it is 325,000 only. So, any chargeable lifetime transfer in excess of the nil rate band are taxed. Of course, the rate of the tax will depend on who is paying, the transfer or the transferee. Okay. So, for lifetime, the NRB applicable at the time of gift is used. Now, the NRB of 325,000 is there, provided to you in your exam. Okay, under the tax rates and allowances. If NRB for the previous year is required, it will be provided in the question. The 7-year accumulation principle. Finally, what is this 7-year accumulation principle? To utilize, okay, to see how much of the nil rate band is remaining, you need to go back up to 7 years before the date of the gift. From the date of your gift, you need to go 7 years back. All your gift is accumulating. They are not treated as in an isolated, no. So your nil rate band is available for a 7-year accumulation period. IHT is calculated on each lifetime transfer when it becomes chargeable, either in stage 1 or 2. That means both PAT and CLT are included in this 7-year accumulation principle. If your accumulated total chargeable transfer exceeds the nil rate band, excess is taxable. So every time you are making a CLT, you have to look back 7 years to calculate how much of the nil rate band is available to set against the particular gift. If it's more than 7 years, you can ignore it. Because any CLT in the 7 years before your current transfer are deemed to have used the nil rate band first. It will follow the order. First gift will utilize the NRB first, then second gift, then third gift, then fourth gift, like that it will keep on using. Although PET uses annual exemption during the transferor's lifetime, they do not affect the nil rate band. See, your PET will not affect the nil rate ban available. Why? Because they are not yet chargeable or they never be chargeable. That's why. So, the available nil rate ban on any lifetime transfer is the nil rate ban at the time of gift less any CLT in the 7 years before the gift. Then the tax is calculated on the excess after the exemptions and everything, and after nil rate ban has been deducted. After this, the gross value of the gift is calculated in order to see how much of the nil rate ban this gift will use up for future transfer. You have to always keep the gross value of the gift and keep it ready. Calculate it and keep it ready. Because in the future, how much of the nil rate ban will be used will depend on the gross value of gift. This is shown in activity 2. Gross chargeable transfer will use up the nil rate ban for future gift. Gift less exemption if transferee pays IST. Gift less exemption plus IST paid if transferee pays the IST. Now, so the IST position should be checked for each CLT separately in chronological order. This is a long task, by the way, let me tell you. Okay, it's quite a lot of things to do. You need to be a little, you have to have a good speed here. Because most probably in your exam, this is the area where students often can score good amount of marks, but they lose it because it's a lot of work to do here. Unlike your income tax or capital gain tax, they are quite little easier. Okay, here a lot of workings are required. You always have to check the date. Always have to keep the 7 years into keep on checking 7 years from the date of each gift. You have to go 7 years back and see. And the available NRV for the death state is calculated by taking the NRV at the time of death and deducting the total of the gross chargeable transfer. Chargeable transfer means all your CLT and PET, which have become chargeable on death, made in the 7 years before the death. When it is in the death state you are doing, you have to compare from the date of death, you have to go 7 years back to see are you making any CLT and PLT 7 years before the death. Now, activity 2. So, activity 2 is a very good question. Here we are going to go through chargeable lifetime transfer. So, Mr. Wealthy, a married man whose wife is still alive, made the following years during his lifetime. Okay. If you see the tax year, this tax year is 2021. Then these two are in the same tax year, 22, 23. Okay. And the nil rate ban is 325. Now you have to calculate the IST that is arising on the chargeable lifetime transfer. So there is one, this is CLT, this is PET, and this is CLT. So here, trustees will pay the IST. That means 20%. Here, Mr. Wealthy will pay the IST. That means 25%. It's a net. Okay. So 333, 50, and 100,000. So let us calculate. So for activity 2, first we'll do in the order. If you see the first gift, which is 2020, it is in the tax year 2021, and the last two gifts are in the year 22-23. So now first we are going to go through here. So the first one is 2020-21. Here it is a gift to trust. Which is the worth is 3330. Okay, as you can see here. So from here we are going to deduct annual exempt, the current and the brought forward. So here we have 2020-21, $3,000, and the brought forward balance from the previous year, 2019-20. 2019, 20 brought forward 3000. So now the chargeable value is 327,000. This is the chargeable value. Now you need to know how much of the nil rate is remaining, nil rate band. There are no bits before this, so you will be eligible for the full nil rate band, that is 325,000. You did not utilize the nil rate band in the previous 7 years because this is the first gift. So 325,000. You're going to do the sum function. Wait. So now we are going to do the sum function. So your taxable amount is 2,000. Now who is paying it? Trustees. So trustees is the donee. So donees will pay at 20%. Okay. So tax will be at 20%. IST would be at 20%. So it's 20% of 2,000. Okay. It is 20% of 2,000, which is the taxable amount. So the tax is 400, and this will be payable by trustees. 400 only because this is the gross amount. Now, moving on to the next gift. Okay, in the different tax year, that is 22, 23. So here it is gift to daughter. The value is 50,000. Okay, so this 50,000 will be deducted by the annual exempt amount. Annual exempt of 22, 23. Then 21, 22 brought forward. Minus 3,000. And then we are going to do the sum function. So the chargeable amount is 44,000. This is pet because this was trust, but this one is pet because you are giving it to daughter. Okay, so no lifetime tax payable. Now moving on to the next case in the same tax year, that is gift to trust. The value is 100,000. Here we don't have any annual exempt amount left in the current year, now the brought forward, because we have utilized it here in the gift to the daughter. Okay, so we have nothing to deduct. Okay, it would be 0. 22, 23, and 21, 24 is also 0, and here pet is 100. So now on this 100 you will be taxed, this taxable amount. Okay, remember we have utilized the nil rate band entirely in the previous 7 year. So now we don't have any more nil rate band, and this is paid by whom? Mr. Wealthy, the donor. So donor will be 25%. Okay. So the tax would be 25% of this. This is no longer PET. It's a chargeable value. So the tax is 25,000. Okay. So remember, this is the net figure, that 100,000, and this 25,000. You have to add them together to find the gross chargeable amount carried forward. So gross chargeable amount carried forward. You should always calculate this. Okay, that is your gift to the trust plus the tax. This always happens when the donor pays. Okay, it's always the case. So now, what's next? Now, we will be moving on to activity 3. With this, we have finished activity 2. Activity 3 is using the same information as activity 2, except the gift on 1st September 2020 was 233. Calculate IST. It was 333, now it's 233. So now we'll go in the same here, same piece of information, and here we'll just change it to 233. Annual exempt amount, everything remains same. Here your chargeable value is 227. Okay, so your nil rate band, you will have some remaining. Okay, your nil rate band also will be 227. So now no taxable amount, nothing, everything is 0. See here, it is 0 here. Now moving on to the next. When you are giving it to daughter, here 50,000. Here there is no change, this is PET, it remains at 44. Moving to the trust, here the impact will come here in the last one. Here out of 325 you have utilized how much for the first gift? 227. So the balance you can utilize here. Yeah, so 325,000 minus 227. So the balance 98,000 you can utilize here against the nil rate band. So here 98,000 you can deduct. So from 100, if you deduct 98,000, you will only be taxed on the 2,000. Okay, and this 2,000, if you are taking the tax 25% on this 2,000, that is 500. This is nil rate band remaining. Okay, then this is the taxable amount. This is the tax. And now the amount to be carried forward, gross chargeable amount carried forward. Would be your 100,000 gift to the trust plus the tax of 500. Now moving on to activity 4. So in activity 4, as you can see, there are gifts The first two gifts are to the trust. In the first one, the donor is paying. Second one, donee is paying. The third one is bet, which is paid to the son, and the last one is again chargeable transfer because it is to the trust. And the name rate ban is 325. So if you see the years, the first two are in the different tax years, but the last two, May 2023 and April 2024, falls in the same tax year. And they did not say anything about death. So we'll assume PAT is not chargeable, but we have to calculate PAT and it will utilize the annual exempt, but it will not have an impact on the nil rate ban. So let us do activity 4. So the first gift which is paid to trust is 335,000. So we'll adjust here. It is in the tax year 2012-13. 12-13. Gift to trust, which is 335,000. And then we are going to deduct the annual exempt amount. Sorry, this is 2011-12 is the wrong tax year. Now, annual exempt amount 2011-12 first, because that is the current year annual exempt 3,000, and then brought forward 2010-11. 3,000. So now it's 329,000, and since there is no gift in 7 years before this, so the full band is available 325,000. So 4,000 taxi. There are no nil rate band available after this gift because the entire amount is utilized in the first gift itself, which is gift to trust in 2011-12. So you are left with the taxable amount 4,000. And who is paying? The donor is paying. If the donor is paying, it would be 25%. So 25% of 4,000 is 800. Okay. Now, it's 25%. Okay. 25% on 4,000 is 1,000. So now the gross chargeable amount. What would be the gross chargeable amount? It would be this. Look at the chargeable value. See here, if you want you gross chargeable amount. So gross chargeable amount would be the chargeable value plus the tax 1,000, 330,000. Now moving on to the next gift, which is 2018-19. For 2018-19, it is a gift to trust once again. So what is the value? It is 250,000. 250,000. And now we will be deducting the annual exempt amount. So first is the current year 2018-19, and the next is the brought forward, which is 2017-18. Okay, so The final is 244,000. This is the chargeable value. Okay. Now, what is the nil rate band? Okay. So you to decide your nil rate band remaining, you always have to see the gross chargeable amount. This is why we have to calculate this. For the next gift, it's important. Okay, so your nil rate band we utilize by gross chargeable amount. Okay, I'm sorry, it is not the chargeable value. It is the gross chargeable amount you have to compare with. 330. So even with the gross chargeable amount, if you compare, your nil rate band is 325,000. The entire amount has been utilized here. Okay. So from your nil rate band 325, you have to see this gross chargeable amount. If it was less than the nil rate band, you still have some nil rate band available for the next gift. But since this 330 is more than 325, the nil rate band, the gross chargeable amount, you have nothing to utilize for the next gift. That means the entire nil rate band has been utilized against the first gift, that is in 2011-12. So now no nil rate band, this 244 is only the amount. Okay, and so the tax would be at what? This time the trust is paying it, so tax would be at 20%. 20% on this, it's 48,800. You don't have to add it with the chargeable value because this is the gross amount. Okay, next we are moving on to 2023-24. So here it is gift to son. So the value is 150,000. So from 150,000 we utilize the annual exempt 23-24 first. $3,000, and then the brought forward from previous year 22-23. Minus 3,000. So CLT would be 144,000. Remember, this is pet, so no lifetime tax. Okay. Now the last gift, also in the same tax year, which is gift to trust. Same tax year 23-24. Gift to trust, which is 110,000. This time you don't have any annual exempt amount. You see, because already in the same tax year, the gift to son, you have utilized it, and you have used the previous year's annual exempt amount also, the brought forward 22-23. So you have no annual exempt amount remaining here. But still, when you are doing it, you have to show that the exemptions are 0. So this too, let me copy it here. 0, because nothing is remaining. Okay, so your value is, chargeable value is 110,000. 110,000. Now, most of you might do this mistake thinking the nil rate band is not available. So that's why after every git you have to go 7 years back. So from 2000 23, 24. Go 7 years back. Okay. It's 2016-17. So after any gift after 2016-17, only you will utilize a nil rate ban. So that means the first gift that you have made 2011-12, this is more than 7 years from the last gift. So you can ignore this. Okay. So thereafter, from 2018-19 onwards, you have to calculate all the gift and see how much nil rate ban they have utilized. Understanding? Only the chargeable lifetime transfer, not the pet. So we have one here, 244. Okay, this 244. Okay, I will highlight it. This is a chargeable transfer within 7 years. And the next gift. This is gift to son. This is pet. Pet is ignored. Okay, it's only CLT. So only one CLT we have made of 244, which is less than a nil rate ban. So now we'll be calculating nil rate band. So the nil rate band will be 325,000 minus 144. Sorry, 244,000. The CLTs you have made in 2017-18 because it falls within the 7 years period. So 81,000 is left. So this 81,000 you can deduct. Just put, okay, since now you know the figure, just put minus 81,000 and taxable amount. So I'm going to use the sum function. Is 29,000. And who is paying the tax? Mr. Rich. So it would be 25%. So equals to 25% into the taxable amount. So the gross chargeable transfer. This is for the next gift unit, but for this question, still you have to calculate and give. You will be given marks for this, okay? So this will be equal to your taxable amount plus your tax. Okay, I'm sorry, it is equals to your gross chargeable amount, not the taxable amount. So the mistake I've done. It is this, the gift return, your transfer of value. So this is your gross chargeable amount. So this is the answer for activity 2. Okay, always start with the date, which date you're writing, and it is gift to whom. Okay, then we start always for any question. Transfer of value, which is given in the question. Then first you deduct the current year exemption. Okay, it's always by the tax year. And then the previous tax year brought forward exemption if it's applicable. Also see whether it's applicable or not. Then since this is the first gift, you'll be having the full nil rate ban available. Okay, see from here 2020-21 nil rate ban, you have to see whether you have made any CLT, chargeable lifetime transfer. That means any gift to trust in the prior 7 years. Pet are not considered. So you have not made, that's why it's 0. So your full 325,000 nil rate ban was available, which you have deducted. This is the amount. Who is paying it? The trustees, the donee. So it is just 20% on 2,000, which is 400. Okay, and always calculate. This is a must. Okay, often students ignore this. After IST, they just go to the next question. No, you need it. When you need the nil rate ban within 7 years, okay, that accumulation period, you need this gross chargeable amount only. So how do you get that gross chargeable amount? It is simply this chargeable value before deducting the rate ban. Okay, it is this chargeable value. But if it is paid by the trustee, the donor, with this chargeable value, you have to add this 25% tax also. That is the only difference within who is paying. But if it's pet, you can ignore it. For pet, you don't have to calculate the gross chargeable amount because pet doesn't utilize the nil rate ban, only the annual exemption. Next, moving on to the next, give to daughter. As you see, it's a pet. So just calculate pet and keep quiet. And since it's a new tax year, so you have both the tax year's annual exemption available. You see, it's the same way, transfer of value less and exemptions and pet. You have to write whether it's pet or chargeable life transfer. Then moving on to the third gift, the last gift, that is again gift to trust. But here it's in the same tax year as gifting to the daughter. So that's why you don't have any annual exemptions left. Everything is utilized. Annual rate ban, you see, CLT prior 7 years. You have made the first gift. If you go back, it is within 7 years. And that it has utilized 327. So this 27 is nothing but since this gross chargeable amount. You see, that's why you have to calculate. So your nil rate ban has been utilized by that. There is nothing left. This is your taxable amount. Donor is paying, that is Mr. Wealthy. So you take 25%, which is 25,000. This 25,000 you have to add with your chargeable value 100, and hence your gross chargeable amount is 125,000. Now moving on to the next, activity 3. All the fact except here on 1st September 2020 the gift value is 233. So first gift, there is no impact. Okay, the only thing is here it's 233. So the entire amount is covered by the nil rate ban. That means nothing is taxable. Moving on to the next, here there is no impact, gift to daughter. Third, the impact is here. Now you will have some nil rate band remaining because it's less than 327, less than 325. So the remaining you will utilize here. Okay, and this is your tax. This 500 you will add with gross chargeable. This is your gross chargeable carried forward. This area, it matters. Now moving on to activity 4. These two are in different tax years. These two are in the same tax year. Okay, so you have made give to trust. Here donor is paying, here trustees are paying, then this is a pet, again this is a CLT. Now moving on to first gift. So first gift, you utilize the full nil rate band. Okay, the donor is paying, so you take the tax and add with this one 329, hence your gross chargeable amount is 330. Moving on to the next gift. Here you have made CLT prior in 7 years, that is 320, the previous gift. This you can deduct. So with this, if you deduct from 325, it's more than the nil rate band, so you have no nil rate band available. Get it taxed. Trustee is paying, so just this tax, enough. Your gross chargeable amount will be this only. Okay, carry it forward. Now moving on to the third, is a pet, gift to son, no issue. The last gift, again gift to trust. The impact will fall here. See, when you have to go 7 years back, okay, it's 1st April 2024. So if you go 7 years back, this 2012 is more than 7 years, so this does not fall. Ignore. Okay, but the next gift, here this gross chargeable amount you need 244 because it falls within 7 years, 2018. And this gift to son you can ignore, it's a pet, only CLT. So that's why 244, the gross chargeable amount of the second gift you are deducting from the nil rate band. So this is your nil rate band available now. Deduct and get the tax. This 7250 you will add with 110, and this will be your gross chargeable amount carried forward. Up to that much we have done. Now the fifth part, that is IST payable on death. So on the death, IST would arise in the following circumstances: when the donor dies within 7 years, that means 1 to 7 years of making the gift, IST is chargeable. Okay, if this happens, IST will be chargeable on the pet. Whatever the pet was not chargeable during the gift, now at the death of the donor, it will become payable for the first time. And Whatever CLT you have paid tax, there will be an additional IST now. That is known as death tax. And IST will be paid on your death state also. That is all. You add up all the value of your assets and liabilities, your property, and there is an IST at 40%. That's why it's double the lifetime transfer rate. See, lifetime transfer rate is what? 20% IST. If the trustees are paying, if the donor is paying is 25, but still the death tax is double the rate. It's more. Okay, but under one circumstance, even this death rate 40% can be reduced to 36%. That is when you are giving enough of your amount to charity. That we'll see later how it is reduced. Okay, so now death tax on lifetime transfer is a stage 2 computation. So calculate death tax on your lifetime transfer, and this lifetime transfer could include both your PAT or CLT. Okay, and remember the IST payable on your lifetime gift, because as a result of death is always paid by the recipient of the gift. Of course, how can the donor pay? Donor is dying, no? Because the donor is dying, you have to pay IST. So who is paying? The recipient of the gift. Okay. So if it's a trust, trustees will pay, and if it's pet, whoever the son, the daughter, the wife, they will pay. Now, IST is calculated on all gifts falling within 7 years, ending with death, taking each gift in chronological order and applying the death rate of tax and nil rate band. Here also nil rate band applies. So that 7 year accumulation period you have to take. How do you take? You go back from the date of death 7 years back and see what are the gifts you have made. Now, so calculate the debt test. The tax of for each gift should be calculated separately. Following steps should be followed. First, use the lifetime prepared for lifetime gifts. Identify all the gifts within 7 years before death. Delete any pet more than 7 years before death. If you are having any pet which is more than 7 years, they are exempt after death. So ignore them. And calculate the gross chargeable amount of each gift and any lifetime tax paid. That is, IST starts on the value of gifts after reliefs and exemption. Next, calculate the nil rate band that is available after you deduct the gross chargeable transfer in the 7 years before the gift. So use the nil rate band for the tax year of death and include pet which now becomes chargeable on death. Remember, now when you're calculating nil rate band, pet will be included if it becomes chargeable on death. Then calculate the death tax, that is excess over your nil rate band at 40%. And then calculate and deduct any tapper relief. One more relief is available. This is only when you're dying. Donor is dying within 7 years. What is it? It says if you're dying within 1 to 7 years. See, the more you survive, the more percentage you are getting. The lesser you survive, heavier IST you have to pay. The more you're surviving, the lesser tax you have to pay. This will cover in the next section. What is this tapper relief? This you can deduct. And then deduct any tax that you have paid lifetime on CLT. When you are alive, the tax you must have paid same IST, right? That now you deduct. Now, so the gross chargeable amount is for pet. Amount of your pet less all the exemptions is your gross chargeable value. For CLT, we derive from the stage 1 computation. We have seen it, right? And if it is the transferee who is paying the IST, then gift less your exemptions, gift your annual exemption or any other exemptions if you have, like marriage exemption, small gift exemption, things like that. Then if it's the donor who is paying, transferor, then your gift less exemption, this is correct. With this you have to add your IST that you have paid. That is the only difference. Now, what about the 7 year accumulation? So now the accumulation period means the starting point for this computation is the 7 year accumulation of your gross chargeable transfer at the date of the earliest transfer, falling into the 7 years ending with death. That means you have to go 7 years back from the date of your death. Okay. And it is necessary to look 7 years from the date of each gift and include the gross chargeable amount of all CLT and PET. As a result, a CLT made more than 7 years before death. See, a CLT made more than 7 years before death can still impact your nil rate band when you are calculating death tax on lifetime transfer. So for PET, there is no issue because PET is become chargeable for the first time. But when it is CLT and it is made more than 7 years before your death, still it can impact your nil rate band when you're calculating death tax on your lifetime transfer. We'll see through the question how. And death tax on your lifetime is a stage 2 computation and is always paid by the transferee. Grossing up never applies. So here you don't have to gross up. When do you have to gross up? When the transferor is paying. But here, no need to gross up. This is an example. So the transferor dies on 1st August 2024, making a chargeable lifetime transfer 1st July 2014. If you see, it's 10 years back. And a potential exempt transfer on 1st May 2019. This is within 7 years. So what do you do? So your 7 years from 1st August 2024, if you go 7 years back, it starts 1st August 2017. This is 7 years. So anything within this will utilize your nil rate band. And this you can ignore. Okay. But PET, yes, PET will become chargeable because PET you have paid here. So the taxpayer's death causes the PET to become chargeable. But there is no additional tax on your CLD as this concern is more than 7 years before. However, although not taxable as a result of death, but the gross chargeable value will utilize the part of your see when you were calculating the tax on CLT, not on death, but when he was alive, then you must have calculated the gross chargeable value, right? As a stage 1 computation. So that will utilize your nil rate band. That would be available for your PET later on. Can you understand? When you were alive, stage 1 computation, you must have calculated. You might not have to pay additional tax due to death, but first time you are paying tax, that you have to pay when the donor was alive, known as stage 1 computation. So there it will utilize your nil rate band, which would be available for your PET when the donor dies. That is on 1st May 2019. So will determine how much death tax stage 2 tax is payable on PET. That will determine how much death tax will be payable on your PET. Okay. Now, tapper relief. So whether a gift is CLT or a PET, okay, if it is made between 3 and 7 years before the date of death, tax liability is reduced by tapper relief. So if the donor is dying within 7 years but surviving more than 3 years, that means between 3 to 7 years he's dying. Yes, he has to pay IST, but it will be reduced, lower IST, because your IST will be reduced by your tapper relief, like this. If you are surviving more than 3 years but you are dying less than 4 years, relief is up to 20%. If you are surviving more than 4 but less than 5, relief is 40. You see, it's increasing 20%. 1 year additional, it will increase more than 20. More than 6 but less than 7, 20, 40, 60, 80. So these are the 4. This thing, there is no 100% relief. Because if you are surviving more than 7 years, 100% relief. Yes, it's not written because you don't have to pay any tax. So it's more than 3. That means at least 3 years you have to survive for this tapper relief to be applicable. Otherwise, it will not be eligible. If you are, let's say, surviving 1 year or 2 years, you are dying, you have made a gift, and after 1 year you died, or after 2 years you died from the date of your gift, no tapper relief, 0. But if you are living more than 3 years, less than 4, then 20% relief. More than 4, 5, 40, more than 5, 6, 60, more than 6, 7, 80. The more, one more year you're surviving, keep on adding 20%. More the years, more the relief. Now, in the case of CLT, okay, what happens? You are paying additional tax. So that additional tax payable is determined by deducting the lifetime tax already paid from the current charge after tapper relief. See, when you're deducting the lifetime tax that you've already paid, how do you deduct for CLT? This is only for CLT. Whatever is your current charge, after the tapper relief only you will deduct. You understand? And if tax on death if tax at death on a CLT is exceeded by a TAPA relief and the lifetime tax paid, then there is no additional tax that is due. That means your TAPA relief is more than the tax at death on a CLT. So there is no additional tax due. Neither there is a repayment of lifetime IST. You are not going to get any repayment of lifetime IST you have paid. Because this earlier liability was correctly calculated using the nil rate band and the rate in force at the time of the gift. So no repayment. Now some exam advice. Rates of TAPA relief will be given to you in your exam. So in case you forgot, do not worry. Now let us go through the pro forma, the stage 2 computation. This is when you are calculating additional IST on your lifetime transfer. So gross CLT or PET, deduct nil rate band on death 325, deduct anything 7 years prior to gift. Available nil rate band you deduct from gross CLT or PET, that is your taxable amount. Take tax at 40% and deduct TAPA relief. Remember, TAPA relief only you will deduct after you calculate tax at 40%. Okay, so it is the percentage into IST 20, 40, 60, 80 depending on the years you are surviving, and then deduct lifetime tax. See, first you deduct first and this you deduct second, the lifetime tax on CLT. Then additional death tax due on lifetime gift. Okay, remember this performance, they are going to help you a lot. Now based on that understanding, we are going to do activity 5 stage 2 computation. So facts as in activity 2, except now Mr. Wealthy died on 1st December 2024. So if you see, all these gifts are within 7 years starting from 20. Okay, so now same information as activity 2. So let us calculate IST. So now as Mr. Wealthy dies on 1st December 2024, we have to include all the CLT and the PET 7 years back, that is from 2nd December 2017 to 2024. Okay. Second December 2017. If you go 7 years back to 1st December 2024, we'll be including all the CLT and the PET. Now, so now if you go the gift to the trust, okay, it is so 1st September, this thing. It is 333. So this is the tax year is 2021. 333,000 we will be deducting the 2 annual exempt amount, one the current and the other one is the previous, and the chargeable value. This is as activity 2, 327. Now we'll be deducting the nil rate band 325, and then the taxable amount is 2,000. And when you take the tax, remember here it was 25, but now it's a death tax, so the tax rate will be at 40%. So just change the percentage 40. So now the tax becomes 800. And from here you have to see whether you can deduct any TAPA relief or not in this case. Okay, look at the date. It's 1st September 20. And if we take it to December 2024, okay, so it is between 4 to 5 years, more than 4 years but less than 5 years. So which tax rate should apply? 40%. See, in case you forgot the TAPA relief, it's just You start with year 3. Okay. So year 3 to 4 is 20%. Next year 4 to 5 will be 40%. And if you know the starting point of a tapper relief, it's easier for you to work out. Now, so now we'll be working on the tapper relief. From the date of the gift to his death, he has been alive for 4 years, more than 4 but less than 5. Okay, when you're writing the tapper relief, please write the year, that is 4 to 5. Okay, so it would be at 40%. Now, minus 40, because you'll be deducting it from the tax, 800. So it's 320. Okay, so now we'll be doing the sum function here, which is 480. And from here you have to deduct any lifetime tax paid. This only you will get in your activity 2. Okay, or you can just take 25% of 2000, which was 400, right? So now IHT already paid. Minus 400. Now we'll be doing the sum function to find the total. So it's 80. 80 is your additional tax that is due on death. Okay, this 80 is the additional tax that you have to pay, and it will be paid by the trustee. The next gift, that is 2223. Okay, so the next one will be tax year 2223. Gift to daughter. Okay, this is gift to daughter, and now the pet as per 22 solution was 44,000. Okay, we have already calculated this in activity 2. It was 44,000. Now there is no nil rate band remaining because we have utilized 325 entirely for this gift, the first gift. So now this 44,000 is the taxable amount on which we are going to pay 40%. So tax would be 40% on this. So 17,600 is the tax. So let me highlight the main answers. This one and this one. Now, what's next? You have to see whether there is any tapper relief or not. Okay. See, no lifetime tax paid because it was a pet. You don't have to deduct, but you have to see the tapper relief. So in this case, if you see, yeah, okay. So he died 14 November, 1st November 2024, and the date of the gift is 14 November 2022. So it's more than 2 years but less than 3 years. That's why no tapper relief. This you have to write as a note. Whether the tapper relief is available or not, you should always make a note of it. and this 17,600 will be payable by daughter. Next, gift to trust in the same tax year. So gross chargeable transfer is 125,000. This is, we have already calculated this in the activity 2. Now, nil rate band. Here also we have no nil rate band available. You have to see that. Nil rate band available on death is 325. But if you go to the chargeable transfer, 7 years back, that is from 1st Jan 2023. You see here, from 1st Jan 2003, you have to go 7 years back, which is 2016. So if you see all these gifts, 20, 22, the store gifts falls in the previous 7 year. If you go here, there is no tax that is available because you have utilized the nil rate band already by the previous gift because it falls in the 7 years. Now we don't have any nil rate band, so the taxable amount is 125 on which we have to pay tax. So now the tax would be 40% on this amount, which is 50,000, and you have to pay the lifetime tax that you have deducted minus 125,000. Sorry, minus 25,000. This was calculated in activity 2 already. You have to refer to activity 2 to get this. Okay, so the additional tax that is paid is 25,000. Just take the difference. This is the additional tax, 25,000 you have to pay, and it will be paid by trustees. Now we will be doing activity 6, which is based on your activity 4. Except that Mr. Rich now dies on 10th November 2024. So these are the gifts. Question remains the same. So now let us do it. Okay, remember whatever the gross chargeable value you have found out in activity 4, using that we will be proceeding with this question. Okay. The first one was gift to trust. So the tax year 2012-13. Sorry, 11-12. It's gift to trust. So will this come? You have to pay additional tax for this. Go 7 years from 2024. If you go 7 years back, 2011-12 is more than that. So you can ignore the first gift. The Jan 2012, this tax year you can ignore because more than 7 years before death. So no further inheritance tax is due on that. Now we are directly going to the second gift, which was on 1st August 2018. So 1st August 2018. Okay. 1st August is a gift to trust, and gross chargeable value as per activity 4 is 244,000. 244,000. We have already calculated it. Now you have to see whether any nil rate band is available or not. Nil rate band on death is 325,000. Less gross chargeable transfers in prior 7 years. Okay, so yes, you have a gross chargeable prior 7 years. That is this gift, the first gift, because it falls within 7 years. You see August 2018, and if you see Jan 2012, even though you don't have to pay additional tax, but when you are taking the nil rate band available on death for the second gift, you have to take care of the first gift because it will utilize a nil rate ban. Okay, so here 1st Jan 2012 in activity 4 the gross chargeable value was 330,000. Okay, and now on your death nil rate ban available is 325, which is less than your gross chargeable transfer. That means no nil rate ban available for the second gift. You see, but you have to show it that is not available. So this will be your gift on trust, the value, and this will see your taxable amount on which you have to pay 40% tax. Okay. So now tax is 40% on this. This is the taxable amount, 97,600. And from here you have to deduct tapper relief. Okay, what would be the tapper relief? Students often forget the tapper relief. Please do not forget that. Okay, just see. It was 1st August 2018 to 10 November 2014. So it is more than 6 years but less than 7. So the last one, which is 80%, the highest tapper relief. So here it is 6 to 7, therefore 80%. So here it would be 80%. And then if you deduct the tapper relief from the tax, then the additional IST, the IST is 19,520, but you have to deduct the IST that you have already paid. You paid 48,800. Okay, this is from your activity 4. You see, it's negative. That means you are going to get a repayment of tax. No. You see, your additional tax that you have paid is less than your gross chargeable amount. So this additional, there is no additional tax. It is simply 0. And you are not going to get any repayment. Now moving to the next gift. 1st May 2003, that is gift to son. First May 2023. Gift to son. So it was a pet. Already we have calculated at 144,000. Now you have to see whether any NRV is remaining. Yes, this 244. Okay, because this falls within 7 years. If you go back 7 years from 2023. So here the nil rate ban just insert nil rate ban. Yeah. So the nil rate ban will is 325,000 on death minus this that you have already utilized, 81,000. So 81,000 you can deduct. So then let's do the sum function here. 63,000. Now on this 63,000 we are going to find tax 40%. Which is 25,200. Remember this was PAT, so you did not pay any tax during lifetime. So you don't have to deduct any tax that you have paid. And you have to see whether there is any TAPA relief that is available or not. So in this case, it's from 1st May 2023. Sorry. 1st May 2023 to 10 November 2024. It is less than 3 years, so no taper relief. Now the last one, gift to trust. Okay, 1st April 2004, that is gift to trust. We have already calculated the gross chargeable value as this. It's already there, this one. So from here we'll proceed. There is no nil rate ban available. We have utilized everything. Okay, if you see here, and if you go 7 years back, we have utilized. So no nil rate band. We tax at this amount at 40. This is the taxable amount. You have to see whether you are eligible for any taper relief or not. So here, no, because this is the last gift, right? If the previous gift was not, you're not getting any taper relief because it was less than 3 years. Obviously, the last gift is less than 3 years, so no taper relief. And IHT, because it was CLT, you have to deduct. IHT you have already paid, so it's already here 750 done. So from here we will be deducting this too. 39,650. This is the additional tax which will be paid by trustees. So these are the solution for activity 5. As you can see, Mr. Wealth is dying on 1st December 2024. If you go 7 years back, it is 2 December 2017. Okay, so this is as per activity 2 solution, already calculated, and no gross chargeable transfer in the previous 7 years, it's 0. So the entire amount is applicable. Now the tax is at 40% because it's a death rate, and you are going to get taper relief, and he was alive from 4 to 5 years, so taper relief is 40% on the tax. And then lifetime tax already paid. This we have calculated in activity 2. Okay, that we are deducting now. So this is the additional tax paid. Now next one is the gift to daughter. This is as per activity 2. The older thing is now he's dying. Okay, so there is already, it has been utilized nil rate ban, so no nil rate ban. This is the additional tax at 40%, and no taper relief for daughter because she died within 2 to 3 years. Sorry, the donor, and because it was pet, there was no lifetime tax that was paid for this pet. This is the first time it has been taxed, and it will be paid by the daughter. Third gift, the last gift. Okay, so here in the previous 7 years you have utilized 371. That's more than the nil rate ban. That means no nil rate ban is applicable. How? So if you go back, already 325 you have utilized before. Okay, and then with that you're adding the balance here. So from the first gift and the second gift, nil rate ban, whatever you are utilizing, you are bringing it forward. That's how it is 371. Because in the first one you have utilized 325,000. First gift, second gift, it is 44,000. You see, pet is 44,000. You have utilized. And here it was 325. The entire amount you have utilized. So 325 plus 44 is 371. I'm sorry, you have utilized 327, the first one. First gift you have utilized. So just look at the gross chargeable transfer. That is the amount of nil rate ban you have utilized. 327 plus 44. If you add, is 371. And since it's a gift to trust, you must have paid tax, which is 25. You have to deduct from your tax. An additional tax is 25,000, which will be paid by trustees. Now there is one note. That is, if your tax and your TAPA relief, okay, is more than the tax that you've already paid, you might get a negative figure, right? Additional tax might be a negative figure. So negative figure means you might get a repayment, no? But in this case, even if it's a negative figure, it will be nil. You have to show as zero. You're not going to get any additional tax. Sorry, you're not going to get any repayment. And no additional tax is due also. This we'll see in activity 6. So activity 6 is the same information as activity 4. The only thing is now Mr. Rich dies on 10th November 2024. So what is the impact? So all this we have calculated. We know. So this is the similar to that. I don't have to show anything. The only difference is when we go here, this one. So this is what we have been talking about, the first gift. Your TAPA relief and your tax. If you deduct this amount is less than the tax that you have already paid. You have paid more tax lifetime. But you are not going to get any repayment. You will show this as zero only. Okay, no repayment of your lifetime inheritance tax. So rest all you will be able to get. Here there is no TAPA relief because less than 3 years. Everything is similar. Now we are moving on to the stage 3 computation, the last computation, that is IST on death state. So you should be able to calculate the death state. Okay, that is the value of their estate at death. Inheritance will be charged on that. So this includes the taxpayer's all his assets less all the debt. We are going to put in one sheet and then we are going to calculate inheritance tax on that. Okay. And also there are some exemptions that are available on death. That also we have to look for. Now, most assets in the death state are valued at market value, also known as probate value on death. But life insurance policies will be valued at the proceed that the policy pays out on death rather than the market value. So there we'll see the proceed. Now, repayment and interest only mortgages on property are deducted from the value of the property that they relate to. So this will reduce your related asset. Example, the taxpayer's home rather than the total asset state. The funds which have been invested, not withdrawn from a pension fund, are excluded from the death state. So you have not withdrawn, you have invested in a pension fund. If you have invested in a pension fund, they are excluded from your death state. As such, investing in a pension fund can be a good approach to reducing a person's liability to inheritance tax because it's excluded from death state. That means no inheritance tax you have to pay for investing in pension fund. But if you withdraw from the pension fund, it is included in your death state. So it is possible to withdraw 25% of your pension fund as a tax-free lump sum. This we have covered in pension also, under pension income. That up to 25% of the pension fund, it's tax-free. You can withdraw. After that, it will be taxable. Beyond 25% if you withdraw. So, and any such withdrawal will fall back into the death state. Remember, even if it's tax-free, from income tax, it is tax-free, but you have to pay IST because it will be included in your death state, which is more because 40%. Now, so death incurred before death. If you have incurred any debt before death, you can deduct them only if they are legally enforceable or as imposed by law or death for which the debt is incurred for full consideration. These are the examples where you can deduct your debt. Let's say you have tax bills which were unpaid, unpaid income tax, unpaid CGT. Because law can impose these rules on you that you have to pay, you have an obligation to pay by the law, you can deduct this debt. Then any unpaid household bills like utility bills, credit card debts, these are also deductible. Next, but if you have made any promises without any consideration, that you can't deduct. Let's say you have promised to pay the debt to someone. That promise is not counted. okay, because you cannot legally enforce them. And any gambling debt, they are only deductible if it can be legally enforced. Okay, let's say legal gambling. There are some legal gambling such as betting and gambling at licensed casinos and betting shops. Gambling debts are not deductible if they relate to gambling and if they are not legal. Now, the funeral expenses. There are some reasonable funeral expenses that are deductible. The costs of administrating the state are not deductible. And the only exemption is spouse exemption on death and relevant to your exam also. Then the total chargeable state is taxed using the death rate of IHT, but only if the value of your chargeable state together with your accumulated total of all the gross lifetime transfer in the 7 years before death as per stage 2 exceeds your relevant nil rate band and residence nil rate band. There is a new nil rate band known as residence nil rate band. We'll see in section 6. Okay, you only have to pay IHT on your total chargeable state if it exceeds your nil rate band and residence nil rate band. Now, this is a pro forma. So your freehold property, let's say your main residence, you will include them. You will deduct any interest or repayment mortgage from your freehold property because they are related to freehold property. Then any business, sole trader or partnership will be added. Any stocks and shares including ISS. Remember this is excluded from CGT and income tax but it's there in IHT. Government securities you will add. Insurance policy proceed you will add. Leasehold property you will have. Cars. Cars are not taxable under income tax and capital gain tax, but under inheritance tax there is nothing exempt. Everything is taxable. Personal chattels taxable. Deaths due to the disease. Deceased are the ones who are going to get this debt. It will be added. All these are addition. Cash including ISA. Now we are going to deduct the debts. Then any outstanding tax. Then funeral expense. Then the total is known as value of state. From here we are going to deduct exempt transfer, that is to spouse only. And finally your chargeable state. On your chargeable state only we are going to pay 40% tax. So after the chargeable death state has been calculated like the pro forma, you have to establish your nil rate band and residence nil rate band and then tax on the death state. And this tax on the death state is payable by the personnel representatives. So this is the pro forma. After chargeable state is the continuation. Less residence nil rate band and nil rate. First you have to deduct residence nil rate band before nil rate band always. So add the death 325 and whatever you have utilized in the 7 years before death. So available nil rate band and tax at 40%. Now activity 7. So you have to calculate the IHT arising on the final state of Mr. Wealthy at death. You have to use the facts in activity 2 and 5. Except now he is leaving a state valued 1 million. None of this amount represented residential property. What does it mean? You are not eligible for residence nil rate band because no residential property. You should have a residential property to get residence nil rate band. His debts due at death and funeral expenses are 30,000. His wife is still alive and is wealthy in her own right. Mr. Wealth has not bequeathed any valid estate to her. All the state after tax will pass to his daughter. Remember, daughter, there is no exemption. But spouse, if you would have left a spouse, everything is exempted. But she did not leave anything to his wife. So let us calculate IHT. So let's start activity 2. Where the death state is so death state is 1 million. Next we have funeral expenses. So funeral expenses will be deducting minus 30,000. So total state is 970,000. Now the nil rate ban. Okay. Nil rate ban at death is 325,000. And then we have used in 7 years. I'm not writing the full description, you can do it. So 7 years before death we have used. For this we have to go to activity 5. So for the first gift we have utilized 327,000. 327,000 for the first gift. The gross chargeable state value. The next one is bet 44,000, and the third gift was 125,000. So the total is 496,000 we have utilized. That means no nil rate ban available now. So no available nil rate ban, it is 0. Okay, now from here 970,000, and now we'll be paying tax at 40%. Inheritance tax at 40%. 40% on 970,000. 388,000. So this is the IHT. Now moving on to the next activity, activity 8. Here we are going to go through detailed death state tax computation. This is facts from your activity 4 and 6, except Mr. Rich left the state. So as you can see here we have main residence 1.6 million. Now because we have residence, we are going to have residence nil rate ban as well, which is 175,000, and it's fixed. Okay, so residence and then rented properties, quoted shares, work of hours, cars, proceeds of life insurance, cars held in ISA, other cash deposit, everything you have to take in the state. Nothing is exempt from IST. But if you see some assets like main residence, cars, cash held in ISA, cash deposits, these are excluded from capital gain tax but not inheritance tax. And Rich owed 24,000 income tax and 10,000 CGT when he died. His funeral expenses is 4,000. Cost of administrating is 20,000. Remember, cost of administrating is not deductible. Why? Because you don't owe them at the death. And main residence and further. So he is leaving his main residence of 2 million to his wife. Remember, anything to wife, spouse exemption is there. Everything is exempted. And the remaining state after tax, the residue will be inherited by his son. So on that residue, son has to pay IST. Okay, you have to calculate IST. So now let us quickly do that as well. So here the state we are going to include the main residence 1.6 million. Then we have rented properties 1.2 million. Then we have quoted shares 800,000. Then we have work of arts. $900,000. Then we have cars. $180,000. Then we have life assurance. $300,000. Then we have ISA. $120,000. Then we have other cash. $400,000. Now we are going to take the total of them. The sum function. $5.5 million. Now we are going to deduct funeral expense and unpaid income tax and capital gain tax. So funeral is 4,000 and this is 34,000. So the total is 38,000. Just put a minus before the sum. So it's 38,000. And then we'll be deducting. So first we'll find the sum function before we deduct anything from here. From here we are going to deduct the spouse exemption. You should always mention which exemption it is. Okay. See, this residence is 1.6 and further 2 million he left his spouse. So it's 2 million plus 1.6. So 3.6 million, which will be deducted. Just put a minus. Then we are going to find the chargeable state. When you're working on the death state, always write chargeable state. When you're working on transfer of value, then you can write chargeable value. Okay. Now, the nil rate band. So nil rate band you have already utilized. Okay. If you calculate, go back to the activity. 4 and 6, you have utilized all the 4 gifts. If you add up gross chargeable value with before 7 years, the first 3 gifts have utilized it. So now you don't have anything left for the nil rate band. It is 0. So this entire amount 1862 will be taxable at 40%. So 40% on this chargeable state. 744,800 is your IHT. So this is the answer for activity 7. Leaving the state of 1 million, funeral expense 30. Then the nil rate band, how the 496 they have got. This from the first gift in activity 5. This from the second. This is from the third. This all are within 7 years. The gross chargeable value total 496, which have utilized a nil rate band. So there is no nil rate band available. And then tax at 40%. Now moving on to activity 8. Here we have listed all the values deducted the expenses, and spouse exemption, the total amount is exempted, and got the IST at 40%. Now, nil rate ban. So first 325 of your chargeable transfer of value made in a person's lifetime attracts 0% inheritance tax. This we know. Anything in excess of nil rate ban is taxed at either lifetime, which is 20, or death rate 40. Now, exam advice. The current nil rate band will be given to you in your tax rate, and if you see, it remain unchanged since 2009. It's 325,000 only. If there is any earlier nil rate band earlier than 2009, which is required for your question, they will give you that in the question. But mostly they don't give before 2009. It's 325,000 only all the time. Now, residence nil rate band. This is an additional amount. Okay. To qualify for this, it is in respect of qualifying residential property that is inherited by whom? Direct descendants. Remember, to get residential property, it has to be directly inherited by the direct descendants. That means from father to son, father to daughter. If it's from husband to wife, husband and wife are not descendants of each other, right? So it has to be inherited by direct descendants to claim residential nil rate ban. Now, so the amount is 175. The residence nil rate band is 175,000. Or it could be lower. If the value of your main residence after deducting any repayment, mortgage or interest, only mortgage is less than 175. Whatever the amount, it will be that amount only. Now, this can be further increased by any unused amount from a predeceased spouse. Remember, spouse can transfer the residence nil rate band among each other. Okay, the surviving spouse can claim. The person who has died, let's say husband died, so husband's unused residence nil rate band can go to wife who is surviving. So he might get additional amount that will be taxed at 0%. Now, there are conditions relating to RNRB. They are oldie on death. Direct descendants are your children. Can include stepchildren, adopted children, foster children, and their spouses, and also their descendants. That means your children's spouses and their descendants. Then, property must have been the residence of the deceased at some stage, but not necessarily the main or the actual residence at the date of death. At the date of death, they might not be the main residence, but during some point in their life, it was the residence of the deceased. So these are the three conditions to claim RNRB. Now, the residence NRB, residence nil rate band. This is applied before your main nil rate band. But remember, your nil rate band and residence the total cannot exceed the value of your relevant property. Also, the value of the property is after you deduct any related repayment or interest only mortgage. Then only you see the value of the property. Now, exam advice. An exam question will make clear if residence nil rate ban is available or not. You should assume residence nil rate ban is not available if they have not mentioned main residence in the question. And if you see, more advanced aspect of this topic are excluded from your syllabus. Now, married couples, transferring of nil rate band. So as mentioned, husband and wife, they are separate person. Separate computation has to be there for each spouse. Each spouse are entitled to IST exemption separately and using their nil rate band separately. Now, each spouse has the use of the nil rate band. As each spouse has the use of nil rate band, a married couple, they can transfer up to 650,000. How 650,000? 325 into 2. 2 nil rate band. So up to 650 of property entirely tax free to their children. Both the spouse can do that. Or other beneficiaries. And 1 million if conditions for residence nil rate ban are met. So if one spouse, let's say, has died, then any unused proportion of the nil rate ban of whom the first person to die can be claimed by the surviving spouse, so that the surviving spouse tax is reduced. These are the following points that are important in determining how much unused nil rate band can be claimed. First, value of the unused nil rate band to the surviving spouse is the unused percentage of the nil rate band that was available on the first death, applied to the nil rate band when the surviving spouse dies. Value of the unused nil rate band can never exceed the full value of a nil rate band at the time of the second death if the surviving spouse has two or more former predeceased spouses. Then, the amount of the residence nil rate band available to the surviving spouse is based on the unused proportion of the residence nil rate band available at the time of the second death if none of the residence nil rate band was used on the first death. So there will be two 175,000 each that is available to the surviving spouse. If the death of the first spouse occurred before 6 April 2007, the additional threshold in respect of the residential nil rate band is deemed to be available to the surviving spouse, even though it did not exist at the time of the first death. If you're not understanding this, don't worry, through questions we'll solve this. Always try to do question, then come back to the theory part. Then, so with that understanding, we will be doing example 4 where our residence nil rate band will be restricted. Here Howard died in July 2024, leaving his estate to his grandson Michael. Estate include a home of 600,000, but it is subject to an outstanding repayment mortgage of 450. That means 450,000 you have to deduct from 600,000, and other assets 700. Wife died in 2016, and all her nil rate band was utilized. In August 2001, Howard made a gift to his daughter of 450, which he financed by taking out the mortgage against his home. So now let us do example 4. Okay. So the death estate, home, which was 600,000. Then we have a mortgage to deduct, 450,000. Which is the difference 150,000. So now that will be equal to our residence nil rate band. See, residence nil rate band is 175, but since here the total is 150, residence nil rate band will be restricted to 150,000. Okay. So the sum function. And now your other assets. Other assets are 700,000. And the total will be 700,000. So on the 700,000, we'll be paying IST at 40%. So IST is 280,000. Okay. Now, this happens if he has made gift to his daughter of 450, which he financed by taking out mortgage against his home. Okay. In the next one, If he would have gifted to his daughter from his other assets instead of a mortgage, then the IST would be different. IST would be lower. If Howard had financed his gift to his daughter from his other assets instead of the mortgage. So now what is the value? Home is 600. We would have not deduct the mortgage. The value is 600. And then residence nil rate band. We would be eligible to the two residence nil rate band. Okay, one of the daughter and the other one is the Horvitz. So now in this case, residence nil rate band will be eligible to two residence nil rate band. That is 175,000 into 2, 350,000. So 350,000 if he deducts is 250,000, and then from this 250, okay, from your other assets, you would have deducted the mortgage, which is 700 minus 450,000. Which is 250,000. So from your other assets you will deduct, and then you'll be having 500. And if you are paying IST on this 500, it is 200,000. So you see, you are paying a lower tax. Earlier you were paying at 280, now you are paying at 200. Okay, but because of his death, remember, it's a pet. If he leaves anything to his daughter, it's a pet. Pet also will become chargeable, and also the death state. So pet will calculate. We didn't calculate the pet. Okay, if you see the amount, it is 450. Give to his daughter 450. So here it's 450. We'll deduct the two annual exempt amount current year and the previous year, and also the nil rate band. So this would be taxed at 40%. So due to death, this also will be taxed. Apart from the death state, that is 47,600, stage 2. Now we'll be moving on to activity 9. So that with that we have finished example 4. Now we'll be moving to activity 9, the nil rate band for married couples. So here you have to calculate the nil rate band available to Alan on his death. Here also you have to calculate the nil rate band available to Alan on his death. Now Alan and Deborah are married. Deborah died on 1st May 2006, leaving an estate of 500 entirely to Alan. Because it is with the spouse exemption is there. Now none of the state is residential property, so no residence nil rate band. The nil rate band was 285,000 for 2006-7. Alan died on 10 July 2004, leaving an estate of 1 million with no residential property. So A is normal. B, same fact as A, except now Deborah left 400 of her estate to Alan and the remainder to her sister. You understand? See, it matters a lot to whom you are leaving the estate. The whole calculation changes. So first we'll calculate the A. If you are leaving it entirely to the spouse, how much was the property? It is 500. So 500 total state value. Total state is 500,000. Then you will get spouse exemption. the whole amount is exempted. So that means you don't pay any inheritance tax. Okay. And Deborah has not used any of her nil rate ban. So the nil rate ban available to Alan on his death. Remember, unused nil rate ban claimed by Alan's personal representative. It would be 100%. Which percent? 100% you did not utilize. 100% of 325, not 380, not 285. Okay. It is the percentage that matters. Percentage on first death. So that death was after 2009. So 2009 nil rate ban is 325, not 385, not 285. So 100% of 325,000. So the nil rate ban available would be 325 of Deborah and 325 of Alan. So total 650. Now we will be calculating B, chargeable state of Deborah. So he is having 500 total state in part B also. But now the spouse exemption. You see, he's leaving 400 only. You have to calculate the nil rate ban available to Alan on his death. First one, it is 650. Okay. They are not focused on inheritance, they are focused on nil rate ban available. So here, spouse exemption is 400. You see, 100,000. And from this 100,000, you see, the whole state is less than 285,000, the nil rate ban. So the entire amount will be taxed at 0. Okay. How much Deborah used? 100 of 285. The question is on the nil rate ban. So to calculate, it's 100,000 divided by 285,000. Out of the 285, you have used 100,000. If you convert this in percentage, it's 35. So unused is 100 minus 35. It is 65%. 65% is unused. See, 325 at death of his death, at date of his death. Okay, own nil rate ban. First is own nil rate ban, 325,000 will be available. To find the next one, you need the percentage. Okay, it would be 65% of 325. Remember, unused nil rate ban claimed by Alan's personal representative, which is 325, not 65 of 285. The 285 we use to find this percentage. You see here, this 100. How did we get? So this 100 out of 285, because it was in, when was his death? How much nil rate ban was available that time? 2000. Sorry. See, there are too many questions. That's why we are getting confused. We are in activity 9. When Deborah died. Deborah died on 2006. So unused nil rate ban. That time he must be having 285 nil rate ban. Out of that 100,000 he have utilized. So we found how much he have utilized, 35. So unused. So to get that percentage only we need 285. Okay. So now once we get this unused percentage, we are taking unused percentage of 325,000. This is what you have to understand always. So if you add them together, this is the nil rate ban available according to part B. It's less than 650. You see 536, 250. It's a little complicated, but so in the B, that's the amount of nil rate ban. Now, moving to example 5. So here it is about residence nil rate ban. John and Effie, married couple. Effie died May 2007. Nil rate ban was 300 that time, leaving 242 son, and the rest of the estate to John. John died leaving a estate value 900 including 600 in respect of his home. Neither John nor Epi had made any chargeable transfer. So the nil rate band available on John's death. That is the second death. Okay. Now, so the residence nil rate band would be 175,000 into 2. One is John, the other one is Epi. Okay, and the total is 350,000. This residence nil rate band. If you see the residence nil rate band 350 is less than 600,000, which is your home. Okay, now, so you would have utilized the entire amount 350. It's not restricted. It is less than the 600,000, which is the value of the home. Then this is residence nil rate band. Residence nil rate band. Now we are moving on to the nil rate band. Okay, nil rate band of John. John will be having his own 325,000. You have to work on the FE. So for FE, how do you get it? You see the nil rate band was 300 that time. So from 300, you deduct 240 because you are leaving 240 to his son. So the difference would be the amount that you have utilized. Okay. This, let's put bracket. Divide this by 300,000 because we want to find the percentage. The unused percentage into 325,000. This is how you find the unused percentage. The amount of the gift, that is to the son, 240. This will be deducted from the nil rate band available that time 300. Divide by 300 into 325. So whenever you find that, you will get the unused percentage. That is 65,000. So 65,000 you'll be adding with 325. So the total would be 350 of residence nil rate band plus nil rate band 390. It is 740,000. So this, the way we have done, if you go in the previous question, activity 9, where we got 65 and 35, isn't the same way we have got here, you see? Okay. So try it that way and see. This way. You will be getting the same answer. So this is the answer for example 4, where if it was mortgaged against home, then your residence nil rate band is restricted to 150. This is the IHT 280. And because it is death and it was pet, it becomes chargeable. That also you have to calculate along with the death date. So the value was 450. Then the 2 annual exempt amount, 1 current, 1 previous, and the nil rate band at 40%. Moving on to the next. If it was financed against other assets, then your 450 would be deducted against other assets. Home, you'll be having the full amount, having the 2 residence nil rate band, which will reduce your IHT. Earlier it was 280, now it's 200. By 80,000 it has reduced. Now, activity 9. So activity 9, when it is entire state is in the spouse hand, everything comes under spouse exemption, nothing is taxable. So nil rate ban would be one of his own because nothing is utilized, and the other one from claimed by Alan's personal representative. One at his death, the other one is claimed by Alan's personal representative, the unused amount, so 650. Remember, this unused portion, you should always multiply it with 325,000. Now, the next one, part B. Here you are leaving only 400, not the entire amount with the spouse. So this 100,000, if you see, it is less than 285,000, the nil rate ban that time. That means no IHT. But you need this 285 to find the unused percentage. How? This 100 out of 285. You have utilized 100 out of 285. So 35 is used. The balance, that means 65 is unused. This 65 will be on 325. Like how 100% was on 325, same way. Whatever the percentage is always multiplied by 325, not 285. This 285 in fact is given to find this percentage. First we find the used percentage, that is 35, and then 65. So we add the two, and this is the amount. You see it's less than 650 this time. So moving on to example 5. Here everything is left. Okay, so the amount, the nil rate ban available on John's death, he is leaving a residential property of 600. This is home to Jeopardy. So first John's own, then F is deemed nil rate ban, both will be available. Since they are less than 600,000, that is the value of the home, full residence nil rate ban is available. And residence nil rate ban is fine. Now we are moving on to the nil rate ban. John's nil rate ban is applicable fully. Coming to FE, how to find the unused? See, residence that time was 300. From there, gift was 240. So we deduct 240 we have utilized. Then we divide it by 300. This portion is to find the percentage, which we multiply with 325. This is unused percentage. Just always we do that. Whatever the nil rate ban given that time minus the gift, divide by the nil rate ban available at that time, multiply by 325. So straightly we add them together, and we add this to and get 740 as the answer. Now the next part, which is administration of inheritance tax. Now, so for IHT, a relevant person is required to disclose information relevant to transfers of value, and HMRC determines the amount of tax that is due. Now you see, this is different from your income tax, CGT, corporation tax, and VAT. Why? All the other taxes are self-assessed tax except inheritance. Taxpayer not only discloses information about income gain, but also calculates the tax liabilities. Okay, this we have seen from lecture 16 to 17. Lecture 16 and see lecture 11 and 16. 11 is on the administration of income tax. Lecture 16 is in the administration of capital gain tax, and this is administration of inheritance tax. Now, a relevant person for IHT is the personal representative of the deceased person. Now, personal representatives could be the executor of the person's will or administrator of the person's estate who died in state intestate. Okay, that means without a valid will and having not appointed an executor. Personal representatives are required to submit an account of the lifetime transfer or the estate at death and pay IHT determined by HMRC by the due date. So these are the time. IHT is payable within 6 months of the end of the month of the transfer or death, unless one of the following exceptions apply. If your tax is on CLT between 6 April to 30th September, the due date is due 30th April following the end of the tax year. If the tax is on the death state, then it is 6 months from the end of the month of the death, or on delivery of the state accounts to HMRC if earlier. person who are responsible for paying the tax or may not bear the burden of the tax. So we'll see who is bearing the tax and who is paying the tax. If it's a lifetime tax on a chargeable lifetime transfer, that is trust. If I pay anything to trust, it's a CLT. Then the tax is paid by the transferor, tax is borne by the transferor. Okay. See, unless the transferee has elected to pay the tax, is always the transferor. Tax will be borne by him also, paid by him also. And if it's an additional IST on lifetime transfer due to death, which is stage 2, then whether it's PET or CLT, tax is paid by transferee, borne by transferee. And if it's a death state, it is personal representatives, and tax borne is by the beneficiary of the residue of the state, whoever is having the remaining of the state, the balance, the remaining part. Now, C note. Residue is the total state value available for distribution after you have deduct the specific legacy, the cost of the state administration, and IST liability on the state. That is the residue. So now let us do activity 10. Here John Smith died on 8th June 2024. His death gave rise to tax liability of 210,000. He had a will and appointed a representative. The rest of the state will pass to his son. These are the gifts he have made. 2 CLT and 1 PAT. And tax paid when gift made and due on death. So the trustees of the gift made on 11 June 2018 agreed to pay the tax as when the gift was made. Here the trustees will pay for the first one. Okay. Now, state in relation to the above information. When the tax is due and payable, who pays the tax, who bears the tax? This through a table we can do. So let us do that. If you see here. See, the first one, trustee has agreed. Okay, so 11th June 2018. Trustees will pay the tax, trustees will bear the tax also. Okay, and when is the tax due and payable? Look at the date, 11 June 2018. So it's 30th April 2019. Because it falls within the date that is given in the slides. If it's from April to September, it is next April, 30th April 2019. First gift is over. Now, second gift, 17th August 2022. So this also will be paid 30th April 2023. So you have to see 6 months. Okay. Now, died 8th June 2024. See, the first one was CLT. Okay. Twice you have to pay tax. Additional tax will be, you have to take 6 months from this date, and here you have to see, because it is CLT, 11th June, which is between April to September. So it will fall in 30th April 2019. Okay, this part is over. This is for stage 1. And stage 1, there is no tax paid on PAT. And coming to the next CLT, 6 November 2023. So here also it will be 30th April 2024. So you have to take 6 months. So from November, December, January, February, March, April, May. So it's May, 31st May 2024. And it's just trust. So who will pay? The transferor. They did not elect. So it's John Smith, John Smith. Okay. Now, stage 2. Stage 2 additional tax will be paid now because of death. So if you see that death is 8th June, 6 months if you take from the end of June, July, August, September, October, November, December. So it's 31st December 2024. Stage 2 for the first gift. Second gift also same, and third gift also, all the dates are same, 6 months from the date of death. And for the first gift, it is trustees because they have elected. Second gift, daughter, it's a pet now, it's become chargeable. And third gift, once again trustees. Why? Because it's after death. And the tax on the death state. This will be personal representative who will pay the tax and borne by the son. Okay. Now, that's it. So we have moved on to part 8, lifetime tax planning. Here, some IST planning techniques relate to the use of family trust and fall outside the scope of your syllabus. There are, however, a number of basic issues which should be considered where appropriate. Making the maximum use of available exemptions, particularly the annual exemption, and also the possibility of gifts out of income. The next, gift into trust, such as chargeable lifetime transfer, can be made up to the nil rate band, that is 325, without any immediate charge arising. So this can be repeated on a 7-year cycle as the 7-year accumulation period expires after that. And for 7 years, you will keep on gifting into trust up to the amount of the nil rate band so that you don't have to pay anything. Next, making gift as early as possible. Why? Because if you are making gift as early as possible, you have a high chance of surviving 7 years, such that your pets, they do not become chargeable, and your chargeable lifetime transfer, if it exceeds your nil rate band, okay, then you only have to pay the lifetime tax, that is at 20% if you survive the 7 years. So additional tax you don't have to pay if you make gifts as early as possible. And or if 7 years not survived, at least increasing taper relief. If you are not able to survive the 7 year, at least make sure that if not 7 years, then less than 7 years. But if you make the gift as early as possible, you survive more years, which will increase your taper relief. Now, this will also fix the value of your transfer at an earlier stage. If you make the gift, whatever at the time of gift, your value of transfer is fixed at that time. So, will be of a particular benefit for assets that are expected to appreciate, because the appreciation of asset is not taken into account. On the day of the gift, whatever is the transfer of value, that is only taken and it's locked. Next, there are some disadvantages of making lifetime gift. First, donor will lose the right to use the asset, and any income that comes from that asset will go to the donee. Next, transfer shortly before death is not going to achieve any inheritance tax saving. And also it will result in unnecessary capital gain tax liability. Why? If you are making transfer before death, but transfers on death are exempt from CGT. So CGT, capital gain tax, you also have to consider as well as inheritance tax. Even though it might exempt inheritance, you have to take care of CGT. Next. So all this were lifetime tax planning. Now we are moving to death state planning. When you're planning, you have to consider your residence nil rate band, because this is only available on death. So it may be possible to rearrange your loan or mortgage away from your qualifying property. We have seen that in example 4. So that relief is maximized, because if you deduct the mortgage from your property, you will not get your residence nil rate band. It will be restricted. Okay, rather keep your mortgage or loan against other asset, not qualifying property. Next, as the extra band applies only to homes that are left to direct descendants, make sure that you keep your home to your direct descendants rather than to anyone else, rather than brother, sister, cousin, or wife. Okay. or you can even rearrange your will. Next, example 6. So here we are going to optimize the residence nil rate band. So Tom is living in a house valued at 400,000 and other assets totaling 400. He wants to leave his estate to be shared equally on his death between his adopted son and his brother. If he leaves the home to Huck, what happens? The other assets to Finn. Okay. If he leaves the house to Hunk, that is the brother. Remember, only the main nil rate band is available, 325, because Tom is the brother, not the direct descendant. But if he leaves the home to Finn, the adopted son, then he will also get residence nil rate band of 175 along with this 325. Okay. Now, if he leaves to the Finn, then total nil rate band would be 500. 325 nil rate band plus 175 residence nil rate band. So, which will result in your saving of inheritance of 70,000. Just take 40% and apply on 500. So, now, this would be the case even if he immediately sold the house to Hug or anyone else. Now, so to know the inheritance tax saving, just see, calculate the inheritance when he's leaving to Finn versus when he's leaving to Hug. Now, skipping generation. Skipping generation means when you have made a will that you are going to gift the asset to your grandchildren rather than your children. Okay. So what happens? Inheritance tax will only be charged once when the grandchildren will inherit this asset rather than doing it twice. From children and then grandchildren, it's better directly to grandchildren. Okay. On the death of the grandparent rather than twice if the assets were first inherited by children and then the grandchildren on their parents' death. So that's it for this lecture. From the syllabus, we have covered the first part under inheritance tax section D, that is computing transfer of value. So we identified the persons chargeable. In fact, all are chargeable. In inheritance, nothing is exempt. Then we demonstrate diminution in value, 7-year accumulation period taking into account the nil rate band. Then we understood the lifetime transfer, tax liability and death state, and unused nil rate band between spouses, and also residence nil rate band when residential property is inherited by direct descendants. Then we have covered the exemptions. Small gift exemption, annual exemption, normal expenditure of income. Annual exemption is 3,000 of the current year and 3,000 brought forward. Gift in consideration of marriage, gift between spouses. All these are lifetime gift, okay? Lifetime exemption. Then basic inheritance tax planning. Then we have covered the payment of inheritance. Who is responsible, who is bearing the tax, who is paying the tax, and the due date. Then let us summarize. So inheritance tax is levied on the personal wealth that is transferred by a way of gift or on death. It does not apply to companies. Second, your tax is on transfer of value. Okay. Then, which mostly they will give you. And transfers made between spouses are exempt from IST. Exemptions from IST include annual exemption, all gifts made out of income, small gifts, certain gifts in marriage. And IST is calculated on each lifetime transfer. And it becomes chargeable on the transferor's final state when they die, where we calculate the total of all the chargeable transfer minus your nil rate band. Then IST on lifetime transfer is payable by transferor unless the transferee makes the election that he wants to pay. Gross amount of the transfer will diminishes the state equals the amount of the transfer after exemptions if donee pays, or amount of transfer after exemption plus tax paid if donor pays. This is the only difference. You need this gross amount of transfer, by the way, for the 7-year accumulation period to see how much nil rate band you have utilized. Then transferees must pay tax on gifts that is received within 7 years of the transferor's death based on the value of the gift. When you're taking the gift, take on a chronological order. Anything more than 7 years, ignore. Okay. And also your tax liability will reduce by your tapper relief from 3 years to 7 years. You have to survive at least 3 years. Okay. If you are dying within 1 or 2 years, no tapper relief. So between 3 and 7 years before death, you will get tapper relief. The more you survive, the more tapper relief. It increases from 20, 40, 60, 80. Then, a surviving spouse can claim the unused percentage of their deceased spouse's nil rate band. And if your property is left to the direct descendants, with the nil rate band, you will get residence nil rate band. Residence nil rate band only if it is left with the direct descendants. Your property, your resident cannot be left to your brother, sister, cousin, or spouse, or anyone else. Like your children, grandchildren, if it's left, yes. IST is payable 6 months of the month of transfer or death. 6 months you have to take from the transfer or death. Now, in this, you have two technical articles to read: Inheritance Tax Part 1, Inheritance Tax Part 2. Thank you for watching, and I shall see you in the last lecture of my tax, that is VAT. So with that, we'll conclude the entire session of tax, and make sure that you do revision kit questions and past paper questions on inheritance tax. So with this, I've completed my inheritance tax, and I shall see you in the next lecture. Do not forget to subscribe if you haven't subscribed to my channel. And you can watch all my previous lectures under my tax playlist. Thank you.